Let me give you a quick question. If you had an IRA, a 401k, and an inherited IRA, and you had to take required minimum distributions from all of them, how many accounts would you need to take distributions from? I'll give you the answer on the other side of the intro. Good morning, good afternoon, good evening. My name is Dave Grant. This is the 5-Minute Retirement Plan. Thank you for coming back for another episode. If you listen to our intro, 3 accounts, you got to take RMDs. How many of those accounts do you need to take it from? You can take it from all 3. You can take it from 2. You can take it from 1. But you got to take the RMD every single year. We will get into the finer details of that as we go through this episode. Let's start off from the ground floor. What's an RMD? So that's an acronym. It stands for Required Minimum Distribution. Now, what that means is when you hit a magic age, right now, if you haven't started those RMDs, it's the age of 73, the IRS requires that you take money out of your retirement accounts if you haven't done so already that year. Now, if you are young enough, that age is going to be 75. They're starting to increase the age. It used to be 70 and a half. Then it changed to 72, then it was 73, and then based on your birthday, it's 75. So it's going to be a sliding scale of years. Now, when you're looking at RMDs, there is a formula. What happens is you're taking the value of the account at the end of the last year. Based on your current age, there's a formula that's assessed, and that will give you the dollar amount that you need to take out in the following year. And if you don't, there are strict penalties. Now, how does this work from an account perspective? All right, so it's on the majority of retirement accounts. So we're looking at 401ks, IRAs, not Roth IRAs, a lot of annuities, and we're looking at inherited retirement accounts as well, even inherited Roth accounts. So we're looking at pretty much most of the retirement accounts that we've got under the sun. Now, the reason I gave you that question at the start of the podcast is when you come to calculate RMDs, it can start to get a little hairy if you've got a number of these accounts in there. So let's say, for example, you've got an inherited IRA and your 401k, and you're subject to RMDs on both. They're subject to different formulas. So the 401k is subject to your birth date, and it's going to be the account value at the end of last year. That's going to be the formula that you use to see what amount you need to take out this year. The inherited IRA, if you are not a spouse, so if it came from, say, your mother or your father, you have 10 years on which to take that money out. You don't have to, and this is a gray area with the IRS, take it out every single year, but the end of that 10th year, that account better be empty, or they're going to get pretty mad. So there's no formula on that one. So you do have to be aware of what type of accounts you have and what rules they fall under. Let's add a little bit more complexity into it. Let's say you've got 3 401ks because you haven't consolidated any of them. You've also got 2 IRAs because you haven't consolidated those either. Just bearing in mind, you could have all of these in one account, but I'm not nitpicking here. So you've got 5 accounts, which all have RMDs due on them. You could do this in 2 ways. You can do it in multiple ways, but let's stick to the main 2. You could take the whole RMD out of one account, meaning that you leave the rest of them alone, and one of the accounts just funds that whole RMD for all of those accounts. Or you do the flip side of it, and you take the RMD for each of those accounts out of each of the separate accounts. So you get 5 amounts that's coming into your checking account. Either way is fine with the IRS. They don't care. They just want to make sure that what hits your tax return is the RMD amount that was due for that year based on all of your retirement account balances. Now, let me tell you about how people don't plan for RMDs, and it has good and bad consequences both at the same time. So let's say that you retire at the age of 60 and you've got $1 million in your 401k. By the time you get to 70, it's now $2 million. I'm just playing with numbers. I don't know what it's going to be. Now, if you start playing with numbers and you say, okay, so now I've got 3 more years until I need to take out the RMD. If I leave it alone for another 2 to 3 years, it could be $2.5 million. Again, my math is not going to be great here if we're talking about investment returns, but just roll with it. So you've got an account that is $2 million at the age of 70, or it's going to be $2.5 million by the time you're 73. By the time you get to 73, you are locked into a minimum withdrawal that you have to take every single year, and that amount is going to hit your tax return, and you really can't reduce that amount anyway. What if you could say, okay, at the age of 70, I've got $2 million. Let me start taking some of that money out now. I might not need it, But what I don't want to happen is I don't want to let that account grow and grow and grow, and then I'm stuck at 73 and I have to start taking money out. So if you start taking money out at age 70, you could even start doing this at age 60, and you just start funneling money out of that account, paying taxes on a lower tax bracket than you would do if you were forced at 73. And you can spend that money. It can be part of your retirement plan, or you just move it to a different account. So if you took $100,000 out, pay the taxes on it, move the proceeds over to your taxable account. And then at that point, you're just starting to reduce that balance that's going to be subject to the RMD once you hit age 73. So what is your takeaway from this episode? If you are already in the stages of getting closer to RMD age, I want you to look at the amount of money you have right now in those retirement accounts that's subject to the RMDs. Put a reasonable calculation in to see what amount that is going to be when you hit age 73 and what your RMD amount will be. You can find the calculation on the IRS website as to what that's going to be. It roughly starts off at 4% of the account. I want you to understand, can I and should I be taking money early from that account in order to move it around and pay some taxes at a lower bracket versus leaving it alone? For some people it works, for some people it doesn't. If you have any questions about what is the right strategy for you, I'm your guy. My firm is called Retirement Matters. This is all I talk about all day. So come and find me, ask those questions, and I'd be happy to help. Until next time, take care.